Hello, welcome into today's video. I'm going to be clarifying the difference between what actually value investing is versus what people think value investing is. So the best way to start, I think, is where do most people, and where did I actually think value investing was at? So most people think value investing is essentially buying things cheap. And to an extent, you're right. But the most important thing that I think a lot of people, including myself, have often overlooked is relative to what. And that's the important part here. You are looking for a business which can sustain high returns on its capital and generate large amounts of cash flow, which increase year on year. This is a lot more valuable than a company that's dirt cheap but is stagnant or in decline, particularly over the long term. As an investor. So that's something to really, that's essentially the essence of the video. Now you can click off if you think you're done there, but what I'll give you some examples if that I'd rather go into. You can almost think of like a cheap business as like a treasury bond. You know that it's not going to grow, but it's going to make you, 5% a year, 4% a year every year on its money. Even if you say it's going to make you, I don't know, 15% a year on its money because it's trading at 7 times earnings, right? It's a dirt cheap business. Brilliant. You're making 15% a year. But then as you go out and out, those earnings sort of become less and less valuable as they get discounted. Whereas conversely, if you'd bought a business instead of 7 times earnings, if you'd managed to find a business at even double the price at 14 times earnings, but it's growing 20-30% a year because it has that quality to be able to reinvest its capital at high rates of return, and potentially an asset like business model where it doesn't need to put in loads and loads of capital, and yet it can still continue that growth. Regardless, what you're looking for is high returns on capital sustained over a long period of time that it can grow on top of itself. And if you can find that business for the next 5-10 years that can grow, your treasury bill might pay you more in the first year or two, but what you'll soon realize is that after 3 years of growing at 30% a year, that's a double. That's more than a double, in fact. If you grow at about 25%, just using the rule of 72, if you grow about 24% for 3 years, that right there is a double. So yes, you may be receiving less, but after 5-10 years, that business is going to be producing more in cash flows. And not only that, because it's a higher quality business, it's going to be valued a lot higher valuation, and rightly so, because it's a high quality business in growth that has the ability to not only retain its earnings but grow and compound on top of itself. Whereas the treasury bill sort of expires at some point, and chances are, because this businesses grow or die, because it's staying the same and its earnings are flat or in decline, chances are this business is maturing or going towards the end of its life cycle and isn't necessarily attractive and could actually be worth a lot less over time. I mean, a good example is sort of like the newspaper industry. A lot of the newspaper industry now, yes, they're trading at dirt cheap valuations, but equally they're in decline, and I don't see that reversing anytime soon. So yes, you can get a cheaper valuation, but it's not necessarily worth it. So it's something you have to take into account. This is something that I've been doing recently, where I've been reflecting and sort of, it's hard to quantify. I think that's the difficulty with it, and you can't really fit someone in a bucket. The media can't say, well, you're not really a value investor as such. At that point, it's perhaps even the wrong classification. It's more like you're a long-term value investor who aims to maximize their risk-adjusted returns or something of that nature. It doesn't fit neatly into a bucket as would sort of screening for price to sales or price to earnings or price to book ratio would. That's very easy to sort of clarify and put in a bucket, whereas this necessarily isn't. So that's my sort of take on it. That's the way I've sort of been looking and reflecting on it going forwards. And something potentially for you to sort of digest and think about. Let me know what you think as well. That'd be interesting to hear. Thank you.